Hi, everybody. This is Hyperwave, and I have Tyler here, obviously. I'm a little sleepy, but Tyler is wide awake, so that's a good thing. He is the genius. Today was obviously very interesting, very sad, and that's me going in the background. Okay, there we go. The markets are going wild, and unfortunately, news of Boeing has made Boeing stock fall to really the lows of September 11th. So I'm just going to turn it straight over to Tyler. We're obviously going to talk about Bitcoin. We're going to talk about when tragic events happen in financial markets. What do you do? How do you make sure that your money is safe? Strategically from a money management perspective when unforeseen things happen. And then also just a follow up to the conversation yesterday, which we had about money management more generally. And Tyler, I will switch it right over to you before I continue to make a fool of myself because I'm so tired. Bye, Ty. Hi, Ty.
Hi, Leah. Hi, everybody. Just continuing on with our very informal overview of what's going on. I tried to stress yesterday the fact that in 40 years of doing this stuff across all types of fund asset classes and common asset classes and boring asset classes like short-term bonds and mutual funds and things like that. I've never seen a situation as the one we are now in. And if I knew what I knew today about where we are today, I would have said the same thing 10 years ago, 11 years ago during the last crisis. And certainly in the little crises we've had in, many of you don't remember, but I not only lived through, but had to maneuver my way through them, such as the 1987 stock market crash. And I remember vividly the 1970s. I started in 1975, which happened to be right in the middle of a period that very possibly was as volatile as the one we're in now, with very different results, very different ramifications. And a lot of people got hurt and a lot of people made a lot of money during the 1970s. You've already heard me say that it was a boring time for stocks in general because they hadn't moved since 1965 all the way to 1982. 17 years went by. That's where I started my career. And there were all kinds of things to be watching and looking at, but stocks were not one of them. Commodities were the hottest topic going. And that's what took me to a seminar down in San Diego early in my career where I listened to Larry Williams teach the sequential trading system. It was designed for the commodity markets. I found my first couple of hyperwaves because of what was going on in commodities with the silver market and the gold market and the sugar market. But there were a bunch of other ones like the oil market for both political reasons and inflationary reasons. But all of that back and forth with prices in terms of commodities and interest rates and inflation just put a big damper on the biggest of all of the tradable markets, which was the stock market. And I was a stockbroker. And so I needed to look at other things and try to figure out where people should be. And the firm I started with, Dean Witter Reynolds at the time, had their own investment analysts and strategists. And I assumed, as just a young kid, basically, that they knew what they were talking about. It wasn't until years later that I realized that the people you listen to at a point in time are influenced and biased by their experience. And if their experience had been in the 1950s and early 60s, then the only place to be was the stock market. But in 1965, that came to a halt, and it was 17 years later before we ever broke out above 1,000 on the Dow, which had been hit all the way back in 1965. So you could have gone for 17 years if you were only concentrating on stocks and not made any money. Now, that's also the period of time when Peter Lynch became famous at Fidelity with a brilliant way of investing in certain types of stocks. And he took advantage of that. And he really helped to build up Fidelity to what it is today, basically on his reputation, which then meant that Fidelity could hire other people with as much talent as Peter Lynch had. And if you don't know who Peter Lynch is at the Magellan Fund, you need to go to Amazon and pick up his book that he wrote right after that period. It's a brilliant way of investing in the type of markets they had during that period of time. The reason I'm going through this is I can take you on a very quick journey through asset classes that change and shift. All the people that got excited about gold and silver in the 1970s, because we went from $35 gold in 1971 all the way up to $880. And that's where the gold bugs really were born. But then they stuck with it after 1980. And for the next 20 years, didn't make any money in gold. Now, when I say that, I don't mean that there weren't individuals, anecdotal stories about people that shorted and did things in the futures market and put all kinds of spreads on. I'm just talking about buying and holding an asset. And 95% of all the gold bugs that were born in the 1970s, because of that inflationary period, instead of looking around at, well, stocks haven't done anything for 17 years, therefore maybe I should be looking at that asset class, would have found themselves buying the stock market at 1,000, and over the same 20-year period, it was going to go up 10x during a period of time that gold didn't do anything. That doesn't mean that gold disappeared. It just meant that it wasn't the time to be in that asset class. And then from 1982 all the way to the year 2000, the stock market just kept getting stronger and stronger and stronger. And one of our Twitter followers did a little research and found an article in the Washington Post. Jane Bryant Quinn interviewed me about hyperwave theory, which I had used to get people out in 1987 of the stock market drop. But it turned out that there was a lot about hyperwaves I didn't know at the time, and I had never seen a thing called a funky hyperwave until the Dow crash of 87. Now, hyperwave was able to get us out the week before the crash. And I interpreted that as being a sign we were going to go back to 1,000 on the Dow. We never did. We dropped from about 2,800 down to 1,600. And 22% of that drop came in one day on October the 19th of 1987. After that, the market took 2 years to basically get back up to those tops. It bounced off what I didn't know at the time was a funky hyperwave along the phase 2 line. Since then, I've seen a number of other examples of that. Not many, 1 out of 5 hyperwaves can bounce off of either phase 3 or phase 2 after going all the way up to a phase 3, 4, 5, 6, and into a 7. We're not going to talk hyperwave, but I just wanted to let you know that this individual that found that article asked some great questions about it and said, why were you calling it a hyperwave when it turned out not to be a hyperwave? Well, it was a hyperwave. I just didn't realize it was a mutant we call a funky hyperwave that occurs rarely, but when it does, it simply means the hyperwave is still alive and going. But at the time, I didn't know that, nor did anyone else, because no one else was studying hyperwaves. I was able to catch the top of the Japanese stock market, which had overtaken the US stock market during the 1970s and 80s. And you need to go back and look at that period to understand what a remarkable period it was for Japan. But once again, this theory hyperwave was able to call the top at 38,800 on the Nikkei after it had run all the way up from the low 1,000 mark, built a base between 3,000 and 6,000, then took off to 38,000, but then it peaked. That's a different asset class than the US stock market. When the Japanese market peaked and began going down for the next 20 years, the US stock market climbed from 1990 and had the best 5 years in US stock market history between 1995 and the year 2000. And then after a couple of corrections around the 10,000 level, dropping all the way back down to 6,000, it's run all the way up to 25,000, 26,000, 27,000. Today, while the Japanese stock market hasn't done anything and is still trading well below 30 to 40% lower than it was all the way back in 1989. So even within the area that we call stock market or stock markets, normally many markets around the world are correlated to each other, but not all of them are. And therefore, making a decision to either be in Japan all the way, all the time, or be in gold all the way, all the time, or being in the US stock market all the way, all the time, has always struck me as being very myopic. And most of the time it doesn't hurt you. Some of the time it hurts you very badly. And that's why Leah and I a year ago began talking about trends and money management and asset classes and hierarchies of thinking that are necessary to protect yourself at various times from difficult situations and take advantage at different times of growing situations. Now, that's a lot of work. I mean, it took me decades doing nothing else but looking at these things to come to the conclusions that I'm now teaching as best I can through these vlogs, through our webinars, through our workshops, and even on Twitter. I try to get, I can't spend a great deal of time responding to everyone, but I read everything that comes across. And when I see a number of misconceptions or very intuitive criticisms repeated by a number of people, I almost always get involved, usually just with little blurbs, but I often work them into our vlogs also, just to give a perspective on things. Now, I made a very dramatic statement yesterday, which is that the markets today worldwide at all levels, meaning the bond markets of the world, which basically means interest rates and inflation, or interest rates and disinflation, or interest rates and deflation, all of those work together in the stew that is called fixed income or the bond market. The bond markets, the stock markets worldwide, the precious metals markets, the currency markets, particularly those things that are most sensitive to the US dollar, which is most things, but it's not all things, but it is most currencies around the world, and everything else, including real estate. You go country by country, and there's some big problems in Australia. There's some big problems developing in London. Even in the United States, there's certain types of real estate that are looking very toppy. There's other types of real estate, like our REITs, real estate investment trusts, that are doing terrifically well, mainly because they're paying very high yields. And as long as yields are basically stable, and you've got to admit they're very stable and have been worldwide. Yeah, we've popped ours up a little bit up to the 3% level. But everywhere else, they're stuck at around 1 or 1.5 or 2%. That's a very stable market, even though people's hair alights in great flames every time the Federal Reserve says something or does something. If you step back and just look at it, you've got to say all of that is very stable. Why are interest rates and bonds stable? Because inflation is stable. We're actually in a disinflationary, deflationary period, and that's important to understand when trying to look at all these other asset classes. Very difficult for gold and silver to get excited and break out to the upside unless there's something else going on, and no one can pinpoint that. There's all kinds of theories and everything else, but the trend has been down in the gold and the silver market for 5 years after running up for 12 years to very high highs after being down for 20 years before that. You give me an asset class and I can give you a very quick overview, and I'll take it back 100 years if you want, decade by decade, showing how these asset classes are constantly shifting in terms of weakness and strength. And within each of those asset classes, then all of the sub asset classes in the hierarchy, the stock market in general, stock market broken up into sectors, sectors broken up into industries, industries broken up into individual stocks put together either in a mutual fund that is run by someone, or put together in an ETF that is run by no one. It's a fixed group of those individual stocks. They earn more securities. There are more mutual funds and more ETFs than there are individual stocks. And each of those act differently because of their constituents. So on a day like this, when all of a sudden a act of God or a force majeure or an almost impossible accident takes place in the air with an airplane that was built by Boeing, and it just happened to have done it in earlier months in a similar situation, that particular stock becomes remarkably volatile. And we have been following Boeing because it is in a hyperwave, and just it looked like it was in a 4 going into a 5 on the downside, and all of a sudden it held the 4, if you redraw the Hyperwave 4 line, and shot up to new highs. And then all of a sudden we get this accident. Now, Leah mentioned chaos theory, and black swans and the tails of a bell curve. All of those things are always with us, but at certain times, and I believe this is one of them, at certain times, the forces between supply and demand, between optimism and pessimism, between clarity and chaos, are so great that what occurs is volatility begins to grow. And we've seen that with the VIX running up to 38, and now back down below 15, and now building again. I'm not trying to predict anything here. What I am trying to get everyone to understand is that unless you've got a firm foundation that most of the time you're not going to need, but certain times like this time you need substantially to keep yourself in a solid position. Unless you've got that, and we call it money management, and we throw around metaphors and little idioms to make it easy to remember what the principles are. And the greatest principles for me having to do with investments and money management have to do with the principles that have been proven to you to work in all situations, not just some situations. And those, basically speaking, are number one, diversification across many asset classes, but not blindly. You want to diversify across many asset classes that are in uptrends when you have taken cash and put it at risk. You don't want to diversify blindly across all asset classes with the assumption that more good across that spectrum will drown out the bad, because you have no idea which asset classes are going to get very, very bad and which ones are going to be very, very good unless you're following trends. Now, by trends, I don't mean what happened last week compared to this week. I mean what's happened for the last 2 to 5 years compared to what's happening right now. At the minimum, that to me is an investment trend. And it's one that's easy to spot, and we've given you tools to do that. And one of the things that I found that is a limitation for Leah and myself in this medium is when we do a vlog for 30 minutes or 45 minutes or an hour, or if you can't shut me up, 2 hours, because I'm particularly passionate about that subject. I can just go on forever on it. But what happens is some of you hear it and some of you don't, which means that the second one or the third one or the fourth one, other people are listening to it and they didn't hear that first one. And yeah, some people, believe it or not, have gone back and listened to every one of the vlogs. And we've got a number of clients that have done that on a number of occasions. In other words, listen to all of them 2 or 3 times. Well, that was pretty easy when we had 30 or 50 or 70. Still very time consuming. And God help you if, if you've got that much time on your hands, but we are very grateful that you've done it. My point is that this is not the right medium for learning and understanding principles. You've got to do the work. all we can do is come on and talk about things that we believe are important. But if you hear one thing or hear a tweet or hear that I believe that Bitcoin is going to $1,000, or I think that there's evidence that a 5% weighting in GLDs, gold or GDXs, the mining shares, are warranted, and that's all you hear, and then you come back on Twitter or otherwise and criticize that, I can't take it too seriously if you haven't spent the time to understand what all the principles are that we're using and why those conclusions are being drawn. That's why I was so happy to see this individual on Twitter who I had never talked with before, taking the time to listen and hear about Hyperwave and then go back and research, go back 20 years and look at magazine articles, and then find something that he didn't understand and seemed to be contradictory, and then pose the question. The reason I'm going on about all this is I don't know if we've got another month to go before it hits the fan. I don't know if you've got a year or 2 years or 5 years. All I know is that there is a looming problem, and it's not a theoretical problem. Just pick up the paper, listen to CNBC, read Barron's or The Economist or IBD Daily, look at the charts and see what's happening across the entire spectrum. And what you come away with is a sense of unease that maybe some of you felt back in 2006, 7, and 8, but weren't sure why. It seemed awfully good. Real estate was going up and mortgages were cheap, and wow, everybody could get mortgages. And then you could get a second mortgage and equity loans, and you could buy another house and flip it. That all seems good at the time. Some people were clever enough or were working hard enough to understand that that was a bubble that had come about because of actions of the Federal Reserve years earlier. One followed the other, just as what we've seen in the stock market followed action taken by the Federal Reserve in 2007, 2008, and 2009. And we've tried to lay out in Medium articles and in other things our sense of why, how, where. Obviously, we are not omniscient. 40 years, there are lots of people that have got 40 years of experience. And if you get 100 of us in a room, we'll all disagree on a lot of different things. So it's not the specific advice about a specific thing that we're trying to teach. What it is there are principles that never, ever, ever change. And those principles have to do with you each individually taking the responsibility of understanding this very simple thing about when you work hard and put the time in and convert that work in your education and your experience into cash after you have paid off all your expenses and you have something left over, that thing that you have created, a savings account or a checking account or a surplus, any way you want to talk about it, is precious beyond belief because of what it took to build that up. And therefore, that's point number one. Therefore, you want to be very, very careful at all times, not just in the long run. In 20 or 30 years, things are going to work out. But you need to monitor what you are doing and be diversified across those things that make sense at that point. I could build you a diversified portfolio in the 1970s that did fabulously well. I can build portfolios that did okay and I could build portfolios that were crushed during the 1970s. I could do the same thing in the 80s, the 90s, 2000 to 2010, 2010 to today. But they're all based on principles of weakness and strength, and the simple idea that when money flows out of something, it is going to flow into something else. And when money is flowing into something else, it is coming out of something. And that is not only asset classes, it's also within an asset class. That's why sector rotation in stocks is so important. When energy and utilities and consumer staples are strong, there's a reason for that relative to much more volatile areas of the marketplace. But they will reverse. Money will come out of one into another. And that's why point number 3 is that knowing those trends is very difficult if you make it very difficult. And it's very, very simple if you make it simple. And I think that we teach one of the simplest systems ever devised for telling what a trend is doing, and that's consensia. I think we've also are trying to teach one of the simplest, most powerful patterns I have ever seen, which we call hyperwave. But it's not easy to do in a vlog, and it's almost impossible to do in a webinar and in a workshop because we run out of time. So one of the things I wanted to tell everyone is that when you attend one of our webinars, what we do, what Leah does is she sets up for all the attendees, she sends them invitations to join Telegram. But not just Telegram in general, Telegram in a specific channel-like grouping with other people that attended that particular webinar. And right now we've got 125 individuals in our Hyperwave webinar Telegram channels that are talking and sharing daily about hyperwaves that they're finding, which has helped me cut my workload tremendously down because there's a lot of brilliant people in those groups. They're arguing, they're questioning each other. They're saying, maybe look at it this way. They're drawing lines differently. When they run into problems, they ask Socrates or ask myself or 1 or 4 or 5 or 6 other people that are really engaged in that for help understanding what's going on, posting the charts and posting all kinds of other things that come from YouTube and various mediums. The more I thought about it after we talked last night briefly, that is one of the more important things that people are getting out of what Lee and I are trying to do, is we're introducing you to other people that have the same types of questions and are experimenting and working to understand how all of that works. So those of you that have attended and have not accepted those invitations, and there are not many of you, I'm amazed at how quickly people following one of our webinars or workshops quickly jump into that Telegram and begin contributing and asking questions. Also, there's a bunch of people that are trading in those channels, meaning they are saying, here's what I'm doing with puts, here's what I'm doing with options, I'm doing this with Boeing. We had a bunch of people that were buying Boeing puts prior to this tremendous drop that we had that nobody could see coming, except we were running out of space on sequential. We had gone parabolic to the upside. We were very close, we thought, to breaking down from a 4 to a 5. So there were a lot of people looking at it, but sharing with each other what they were doing, why they were doing it, how they were doing it, what exchanges they were using, what information, how they were drawing their charts, using what kind of things. So it's a very valuable tool. Now, I could be saying this at any point 10 years ago, 20 years ago, 30 years ago, 40 years ago, but I'm saying it particularly today because I do not know which way these markets are about to break. After a day like today, when you have a number of indexes in the stock market going back above their 200-day moving average after breaking down below it, and many stocks and many indexes on nines on the sequential that are refusing to go down, that's building up in my mind the possibility that we are going to break and continue running to new highs. And as soon as we've done that, we are on our way to the upside. I'd give that approximately a 50% chance right now. I am still very worried that the formation that has occurred over the last 14 months, where we are in the cycle, where we are in the longest expansion ever, both economically and for the US stock market, means that any downturn from here is going to be a doozy. And not only that, it builds the possibility that it's going to spark something much bigger having to do with the problem of credit and debt. I can say the exact same thing about the precious metals markets, about the interest rate markets, the inflation, where we are with inflation, the same thing about currencies. The US dollar is in a very, very narrow range between 96 and 97 and a half. If it breaks to the upside, that means all the other currencies are breaking to the downside. We've got people looking at the Turkish lira because it is in a hyperwave. There are all of these conflicting things going on. So what I'm saying is, if you are in markets, any markets, and I'm talking the crypto market, I keep saying that I'm uninterested because the probabilities are so strong in my mind of where it's going, but I'm just following the trend. It's not only because of Hyperwave. Every time I talk about Bitcoin and the other cryptocurrencies, I bring up all the weekly indicators other than Hyperwave to show that the trend is obvious, at least to me, that there is no evidence yet that we are going from a bear market to a bull market. And that's the only thing I'm interested in. If I get evidence that the crypto market, all the crypto market, and or Bitcoin is beginning a trend in the opposite direction, not from last week to this week, not from yesterday to today, not from the last 3 months to today, but a change in which the short, intermediate, and long term are all in line with the price, I will be the first one to come out and say it's time to get back into the crypto market, into Bitcoin. And I am nowhere close to doing that because there is no evidence. But I can do the same thing for all those asset classes I just talked about. And where I am with all these other asset classes is I'm on the fence. And when I'm on the fence, you can be sure I am in cash. And my recommendation to those that are in our consulting group is to also be mainly in cash. And if you are not, to use the principles we've talked about, 60% very broad in terms of indexes, 25% in sectors and industries, and 15% in very speculative things that can move very quickly. A stock like Tesla, like Boeing, like Netflix, like Amazon, like Google. And so many people end up with very large percentages in those things because they look particularly good. And I hope that works out well for them. But that's not what we are teaching. We are teaching when the time is right, you want to be all in. And when the time is not right, you want to be all out. And when you're not sure what time it is, you want to have some exposure to those asset classes that are still trending, and you want to be basically in cash with the rest of your money. And this is the time to think about that. Go back and look at our webinar on money management. For those of you that are very interested in Hyperwave, and there is a growing body of people that have come to the conclusion we were hoping they would come to, which is this thing is real. We don't understand it. I don't understand it. But I know what the rules are and the probabilities are that when one of these things is developing, what it's going to mean. And then just a very brief push once again. We are going to continue in this vein with Hyperwave webinars and workshops until we run out of people that are interested in the topic. And we spent a long time today going through how we're going to go about that and on what frequency we're going to be able to do it, because it takes a huge amount of time to put these things together and a huge amount of time for the people listening to get it all. And that's why I wanted to mention about this Telegram group, because all of a sudden you will have tremendous resources on a daily basis available to you on an ongoing basis if you choose to join. And with that, I will remind you that in 2 weekends from now, we will be holding a high-level webinar on hyperwave trading and hyperwave trading only. And Socrates and I will spend many hours going over a very few number of hyperwaves that are active in great detail using many, many techniques. And one of the things that we will also do is examine in detail 4 different hyperwaves over the last 30 years where I have trading records of how, when, and why I took various positions on the way up, and how, when, and why I got out of those positions on the way down. And I think you'll find that very interesting because of just the practical nature of looking at 4 very different hyperwaves across 4 different asset classes over a very long period of time, where various assets were doing different things at each one of those points in time. I think you'll all find that very interesting. And with that, I'm going to turn it back over to my partner.
Thanks, Ty. I actually got a question in the live chat that I think is prescient to what you're saying right now, which I'm going to answer and then turn it to you just for really quickly. We also said this was going to be 15 minutes long, and we're at 46. So
I know my salmon is burning.
Stop. So someone, I'm looking at the live chat over here, asked about the Shiller PE price to earnings ratio, and then asked, if I understand correctly, from your question, is pretty much what's the difference between the Shiller PE to traditional PE or traditional price to earnings ratios. So why that's interesting, I think, to our conversation is traditional price to earning ratios takes the trailing 12 months into account, while Shiller takes, still trying to find the exact question, but
yeah, his K.
Yeah. So, and the reason that Shiller does it, and then I'm turning it to Ty, is simply because he was trying to eliminate the possibility of fluctuations. So again, this is because the EPS, or earnings per share. Okay, now we're talking about fundamentals a little bit, or as people like to say, FA. So EPS, the denominator in this ratio, also comes down during this period, right? So long story short, Shiller's using a lot longer time period. He's doing this to eliminate fluctuations. I think this is an alignment. Wanted to answer that one because, Ty, as you've been talking about here, the importance of taking a long slice of data to determine trends rather than short chunks.
Yeah, the longer the better always. And then as you get shorter and shorter, it's more fun to talk about because it feels more real as you get closer to the current day. But always you want to go with the longer term. I will post something in the next day or so by Colin Twigs. And for those of you that haven't heard some of my vlogs, Colin Twigs is an analyst down in Australia who does terrific work. And I've followed him for 20 years, but he just recently posted the Shiller's Cape analysis over a long period of time against a more traditional, and he comes to different conclusions in this posting in this article, and it's there's too much to go into right now, but we will put that up, I promise. We'll actually put it on our website, but I'll also tweet it out um, um, so everybody can take a look at it. It's a brilliant piece of work, and it's a controversial. I happen to like Schiller's way of looking at things, and at various points of time, 3, 4, 5, 6 years, it works better than a traditional method of taking a look at valuations. But then it'll go for 2, 3, 4, 5 years where it does not. And that's what Colin Twigs is talking about. So I'll get that out to you.
You know, it could be kind of fun. I would, well, if you don't mind, Ty, maybe on one of these vlogs, I'll teach people how to do the calculations for current and quicks.
Yeah, that'd be great.
So those liquidities, guys, because you like talking about liquidity because it's Bitcoin. But all the different ratios, I think it's not a bad idea if we actually took a look at them. And then just in general, because yes, as we talk about, it's not a fundamental analysis versus traditional technical analysis. It's a plus, it's a marriage. But
that's a great point, because Leah and I are headed in another week or week and a half to Malta. And the reason I am going is because I want and need to learn from the masters the fundamentals of Bitcoin. I've been around it for a long time. I've mined it, as I've talked about years ago. I got caught in Mt. Gox. I decided I wouldn't ever do any of this stuff unless it's on a regulated exchange. That's why I bought GBTC. But it's time for me to sit for hours and hours and hours over a 3-day period, listening to those that are involved in every aspect of what's going on in the programming of the blockchain and all of its derivatives, and really listen to what they say and ask a lot of hard questions. I'm not going to be speaking. I'm there to learn. Those are the fundamentals of the crypto space. Most of these people feel that it's Bitcoin only, but not all of them. A number of them feel that there's a number of other cryptos that have a lot of merit, and I really want to hear their discussion of that from the inside out as opposed to the outside in. So that's a great point, Leah.
Well, that's interesting, Ty. That's bringing up something else. I'll stop rambling. Last thing I was going to say is also just in regards to the Shiller. We should cover it just because of cyclicality. And again, what you're saying with long-term versus short-term. Everyone should keep in mind, you know, the adage of sell in May and go away is coming up, but everybody needs to remember long-term. Yes, so we're going to Malta. It's Understanding Bitcoin. It's Tone's latest one, and it's done with Tone and Adam Back. And Adam Back is absolutely incredible. If anyone here, everybody is coming from crypto for the most part, he's actually mentioned in the white paper. He is, I will say it, I hope he listens. I will tell him in person, but I respect him most in the Bitcoin space. He's just absolutely brilliant. Blockstream. So obviously lots of people from Blockstream. I am on the website looking utterly ridiculous as a medieval warrior because I think I'll be moderating. And yes, that's absolutely true. It's demystifying the tech programming behind and development of Bitcoin, but in ways that people like you, Tyler and I can understand. And I just think that that's really, really important. Oh, by the way, speaking of lightning, yes, Blockstream, Tyler and I have a tip in. So, hey, we're being really cool. But that's also in correlation to, I'm also going to be speaking or moderating actually at the Magical Crypto Conference, if anyone's coming to Blockchain Week. And why that's interesting that I mean that I say it is that, thank you, Fluffy Pony, because I'm moderating a mining panels potentially. And I know nothing about mining. But from this conference, I hope that I learn a lot more about everything in the mining. Slush Pool is going to be there, and just everything is just so interesting, and the innovations are just moving so quickly that on top of the fact that it's already very difficult, there's just so much going on that it becomes more and more difficult to follow and try to understand, all right, what's bad versus trend, what are the real experts, and try to decipher and learn from who's real. And I would say, just adding one more thing to it, because like at Magical Crypto Conference, but well, and then Consensus, but also what we're seeing in Malta, and again, kudos Tone, is to Tyler's point, there's a lot of reasons that people see intrinsic value in Bitcoin. And I would also break that down to Bitcoin as an inspiration and Bitcoin as a standard. So why would, Fidelity, yes, they've been mining, they started mining in 2015, but why are they still interested in throwing so much money down? If everybody's been watching JP Morgan Chase's, Goldman, everybody right now is actually really hot on the subject and throwing a lot of money down, which you wouldn't expect in this market. But again, if these companies believe that at one point Bitcoin will become the de facto standard, or Bitcoin and a gold mixture, or whatever it may be, then of course they're going to want to put money down right now so that when that future is realized, right, that they're revved up and ready to go. Now you have Bitcoin as an inspiration, potentially, right? So Bitcoin as an inspiration, meaning that the underlying tech of what Tyler and I are going to be learning, we need to, take our notepads for sure, at Malta, is so fascinating. I mean, all the absolutely incredible innovation that keeps me up at night. I am sleepless because I have been studying all night. All the tech behind Bitcoin is brilliant. And now you may not need, cryptocurrency for your company, but the advanced cryptography, you may want to learn from, zero knowledge proofs, Z-snarks. You want to utilize, what's the latest that's actually being done in Blockstream, but, apply it to the tech of your company. But not specifically needing cryptocurrency unless you're using it potentially as a motivation and incentivization. But again, to Tyler's point, yes, the fundamentals of what's actually going on in the space, one, extremely complicated. We hope to learn a lot. But two, are so strong. And then three, as a de facto standard or inspiration, in the end of the day, people are still interested. We're waiting for this market. We are talking on this show, and we believe, given that we're going down to the phase one line, that it's going to continue in a bear market. But that doesn't mean, as we have written about, that we are huge bulls long term. And that's because the fundamentals are so very, very strong. And if you want to relate this back to what we've been, talking about here, when someone asked me about the Shiller PE versus regular price to earning ratios, yes, it's by taking that long-term view rather than just watching a trading video every single day and saying up, down, up, down, up, down. Good for you if you're a day trader and you kill it. That's awesome. I suck at that, but I'm trying. But no, by taking a really long-term view, and that matters in following the tech as well as following the price. And trends are obviously qualitative and quantitative. So I will stop talking my diatribe now. Goodbye, Tyler. Last comment. Sorry, man.
No, thank you all very much. We hope to hear you or see you or have you see us in 2 weeks. It's going to be the best of the three that we've done, because we've taken from the first two, and I'm very, very excited because I will be joined by our new partner, Socrates, who's just doing a terrific job. As you know, he's helping us put the book together, and we're meeting several times a week now, getting that done. We want to get it out there so as many people can learn as possible this very powerful tool called Hyperwave. Thank you all very much.
Ciao, everybody. Have a nice night or morning or afternoon or anything. Okay, bye.